Hi guys, 8th of June 2023, Thursday, MAO with Cal once again. All right, Goldman Sachs sees little chance of recession. Really? All right, so this is going to be very interesting because Jeffrey Gundlach actually says that no, there will be recession. So let's see who's actually speaking the truth. All right, let's go. All right, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, first of all, let's discuss what happened last night. Wow, what a move. The Dow Jones up by 91 points, while the NASDAQ down by 254 points. And that's something that I've been saying the last few days about the NASDAQ. I've been telling people this, get out of NASDAQ at 14,500, 14,600 because there will be some selling. Now, Microsoft down by 3%, Google down by 3.78%, Meta down by 2.77%, and NVIDIA down by 3.05%, and Amazon down by 4.25%. Now, we all know that the NASDAQ counters is poised for a sell-off. But the thing is this, I went through the media. They don't really talk about this. In fact, they emphasize on what happened to the bank shares, that the KRE is up by 3%. And of course, energy sector went up by an average of 3%. So what happened to the NASDAQ? Nope, they don't really much bother by it. In fact, now they're saying that now it's a bit of news vacuum right now. Earnings are done. Debt ceiling is almost over, and Federal Reserve likely will pause interest rate according to them. So all this seems that everything is good to go, and that's why probably the Goldman Sachs now is feeling that the market has a good chance of going higher. Now, with the S&P missing the S&P by 1 point to 4,300, undeniable. If you're feeling bullish now, I can understand this because S&P now hit the high of 4299.19 last night before pulling it back. Now, I have been saying this, guys, about 4,300 will be a very good time to take some profit off the market. I repeat myself again, 4,300 is a good time to take profit, and I got my reason to tell you very shortly towards the end of the video. All right. So Goldman Sachs don't really see a recession. In fact, they lower the chance of the US sliding into a recession, okay? And their reason is pretty simple. They feel that now there is from a 25% mark, it was 35% of recession. Now they cut it to 25%, and they feel that, right, the first thing first is that the tail risk of the disruptive debt ceiling fight has disappeared, apparently. And second, now they feel that the baseline estimate for the banking stress will subtract only to a modest 0.4% versus the GDP. So they're trying to say that now the bank side is going to be better, things are doing good, and that's why the bank shares went up yesterday. And then they talk about the debt ceiling is over. But the thing is that they don't talk about anything of the NASDAQ selling off yesterday. That is where the question mark is. And of course, now you look at the percentage of stocks trading above the 200-day MA, well, not bad at all. It's now above the 50% mark. So you can see that just early part of the June period, it was like 38% only. That the last few days, it went past to 50%. So is it time to buy into the market? This is a big question. But of course, many analysts feel that it is, because why? They feel that the earning recession is over. According to the 6-month change in the Conference Board leading indicators versus the net earning revision index, it seems that the analysts are believing that there will be a recovery of the earnings and things can get better. And it's just a matter of time the LEI follow through, and then we'll have a big recovery. Now, I really have my very fearful part of this, because I want to show something very important right here. You can see that back in 2009, we do see something like this. So we need to change the color a little bit. You can see that there was a revision here in the middle of the recession. And then after that, look at it, the whole number plunged down to get an LEI. So what do you think? I really have my doubt. And in fact, just before the COVID-19 issue, we had the same phenomenon whereby the earning revision was revised upwards before it crashed down. So I just seriously believe that this is just made up, manipulated, and it could actually bring sell-off in the very near term. And in fact itself, I believe the sell will happen within the next 2 weeks. All right. See, let me explain to you why do I feel that. Because now the thing is this, everybody feel good. The Chicago Board Option Exchange Volatility Index now is at 14.65. The last time we saw this was basically in 2021 during the September to December period. And of course, we know what happened after that. The stock market actually came off quite a fair bit, yeah? And then the thing is this now, the put call ratio, oh my goodness, just early part, just December this year, it was at a high of 1.7. Now it's low of 0.64. And the last time we saw this was back in 2022, whereby during the April period, where the market was going upwards, and then after that, things start to fall. So when people get complacent itself, it's very normal, and that's the reason why the VIX has traded now to 14. Wow, my goodness. The thing is this, I've been calling for buy on VIX since 16. I'm not going to lie about this. I think that any lower than 16 is a buy. So 16 is a buy, 15 is a buy. Now 14 is a buy. To me, it's all right. The last time we see so low, it was back in all the way in 2022 during the October period. And I still think that now is even lower. This is even better. So to me, 14 is a very strong buy. Don't ask me 12 what I'll be doing. I'll be buying even more. So to me, is that all this complacency speaks for itself. And that's why market is poised for a pullback. Now, the thing is this, Jeffrey Gundlach, right, sees a higher chance of a downturn as economy indicators looks full on recessionary. All right, so the thing is this, he's on DoubleLine Capital. His fund is holding about $92 billion of fund, and definitely he feels that it's actually ready to go in terms of downside. He believes that the ISM new orders and the Purchasing Managers Index are signaling a downturn, which I totally agree. And this call is definitely opposite of Goldman Sachs, as I said earlier. And the thing is this right now, I always believe Goldman Sachs is a very good way to play punk with a lot of people. And so you follow the price action that's more important. In fact, Gundlach says that ISM supplier delivery delays are near at the lowest level in 30 years, showing greater supply than demand, which further indicates a weak economy. I totally agree with this statement. So that's the reason why the China export plunged by 7.5%, far more than expected as well. You look at the number, the market did recover previously to about 15, and then the market cut by half the following month. This is really, really bad, okay? It was from 15.1 in May, and now it's so much lower. That shows that this is just a one-off, and China won't be able to depend on its economy for the next 6 months, according to some people. But my point is this is actually spell the truth of the real world economy. And because of that right now, you can see a very interesting thing, despite they're saying that there'll be no rate hike coming soon. But yesterday, we saw the 10-year yield shooting up to 3.8%. So this doesn't make sense, guys. Something is very wrong. And I suspect that if this number peers past the 3.9% level, this will make the market jump, okay? So again, usually when things, where people are so on one-sided, the opposite will happen. And of course, this following chart is so powerful. Take a look here. Now, this is the call volume versus the put volume. We can see that there is a very strong divergence between them. And the thing is this right now, people are buying so much call. But take note, guys, when this happened, when the thing diverges itself between the put and call ratio, you notice that that is, when you compare to the S&P, it happened before in August 2022, and happened again in February 2023. And the thing is this, watch out for this. Remember August 2022 and February 2023, when this thing happened, when the divergence opened up itself and then complacent is there, the stock market plunged, okay? Take a look. This is August 2022. In the mid of August, the price shoot up all the way. Everybody was so bullish, and the market crashed down all the way itself, minimally to 3,850. So it happened again back then in February, where the market rebounded and everybody thinks coast is clear, thing is good, the market came back down again. So this time around, we're having the same thing, although this time is higher than the previous time. So there could be a bit of bullishness, but if the market really pulls down, I'm strongly believing that the S&P can go down to 3850. But of course, I'm not saying that it will happen immediately. We'll watch the market. What a telltale sign. When that happens itself, you clear the screen a little bit, you will see that the market will engulf. There will be a day whereby the market engulf. So don't you think that yesterday was an engulfing candle? Well, it looks like this. So that's why today, be careful. The market could really move towards the downside. All right. This is Kel signing off. I hope you will make good money from the market. Bye-bye.